Hello and welcome to San Diego Market Watch, where we bring you accurate information every week about the real estate market in San Diego County. Today is September 29th, 2022. Let's jump right into these numbers. As has been the case for the past many weeks and really throughout the entire summer and now into the fall, the number of homes for sale or standing inventory, if that's what you want to call it, has been declining. We sort of reached our peak here at the end of July and have been declining ever since. Now, of course, if you go back further than this chart shows, we were roughly half of the inventory that we have now, but that was a ridiculously low inventory level. It was ridiculously low. There just were not enough homes for sale to meet demand, although now there are more homes for sale than there are homes selling. So that's slightly inverse of what was happening. But as you can see, the number of homes ticked up just a tiny amount from last week. We got about 60 or 65 more this week than we did last week. Not a significant number. And this has been going down all summer, like I said, into the fall, mostly because buyer demand here, pending sales in green, and because new listings have been declining again and again and again every week. We've sort of plateaued out here as we finished out the summer and heading into fall. But again, this week, new listings are down. Now, the other thing I will point out here is that pending sales jump up a bit every time that rates go down a little bit. And that is understandable. You have buyers that want to buy this year. They're just trying to time the market so they don't get the highest interest rate. And we'll talk more about interest rates here in a minute. However, pending sales have remained relatively stable all summer. We do see the last couple of weeks they've been falling off a bit, but why is that? Rates have been going up again. So, closed sales lag right behind pending sales and basically follow those 30 days later, as you can imagine why. So let's jump over here and talk about rates. And yes, you don't have anything wrong with your glasses. You are seeing 6.7% as Freddie Mac's weekly average for mortgage rates in the United States. And that is the highest level since, I believe, a long time ago. I want to say it's I think maybe even 20 years back. It's been a long time since we've had mortgage rates up around 7%, and that's not great. And then the 15-year rate is up around 6, the 5/1 ARM at 5.3, so that's a fairly decent option if you want to roll the dice on rates being lower in 5 years, which, if the increase in rates has the intended result that the Fed is hoping for, then inflation will go down, and therefore investor confidence builds and rates can come back down. So like all other markets, these things fluctuate. And we had been riding interest rates in the 2s and 3s for a really long time, so people got very used to that. But that wasn't normal, just like the level of inventory that we had wasn't normal. So normal would be closer to the 4 and 5% would be a nice place for rates to settle. Now, what can we do about this so that buyers don't have to try and time the market, so we can have a nice steady increase in pending sales from now to the end of the year, and sellers don't have to slash prices ridiculously? What we can do is, as buyer's agents, we can start writing into our contracts rate buy downs. Buyers need to talk to their lender about how many points they can buy, how long they can buy them down for. Is it 2-1 buy down for just 2 years, or is it a full loan buy down for the life of the loan? What can we do here? What are our options? And that will let you, as the buyer, and your buyer's agent know what they should be asking the seller for. Now, if you're going to ask the seller for a substantial credit toward closing costs, you're probably going to have to offer a pretty strong price, and that's understandable. But And as listing agents, we need to be talking to our sellers about the same things. Let's not panic here and slash, $90,000 off our price. Let's try doing, a rate buy down. Let's try advertising that. That can be a little tricky to advertise because there's no field in the MLS for, rate buy down. So it's a little bit of a marketing challenge, but it's more about word of mouth. As a listing agent, when I have people coming in for showings, I want to tell those buyer's agents, hey, make sure your buyers know that this seller is ready to participate in a rate buy down. You can do signs, you can do flyers, you can do all that stuff, but that isn't really getting the eyeballs of the people that you need to have looking at it. Where this is really going to work is with agents talking to each other again. Imagine that. Not buying a home with an app or with a part-time agent. You really want to be working with agents on the buying and the selling side right now that are well established, experienced, they know each other, they have relationships, and they can talk to one another. So that's my rant on rates, my rate rant for the week. Don't worry, we can buy it down, and in a couple of years it'll go down again if you do the ARM option. These aren't the scary ARMs of yesteryear. So with that, let's skip over here to median price. And it's the same as it was last week because we're looking at this month to month. But what has definitely been established now, and I started talking about this last week and I'm going to keep talking about it, what has been established now is momentum. Momentum in the downward direction. We are trending down. And where we land and when we start going back up or stabilizing again has a lot to do with interest rates. In fact, I believe it has almost everything to do with interest rates because demand is there. There just aren't that many homes on the market. The market is not flooded with homes. It's just that buyers are reluctant to pull the trigger at nearly 7%. So that is causing sellers who need to sell to slash prices, and therefore the median price is coming down. So where does it land? Do we land here at where we were in July of 2021? Do we go all the way back here to November or January of 21? Where does it go? Where does it end? That's really anybody's guess. Given the fact that we don't have a giant financial crisis happening right now in terms of industries collapsing, banks failing, things like we had in 2008, and the foreclosure rate in California and the United States in general is very, very, very low. I really do believe that if we can sort of get a handle on rates, get a handle on inflation, things will level out. So I'm at this point sort of predicting / hoping that maybe median price comes down to about where we were in January or maybe December of 21 and doesn't continue to slide back here or even here because anything can happen. But Southern California real estate is characterized by sharp turns upward, followed by sharp turns downward. But if you draw a trend line through it, it's always up. So you can't really lose with real estate. You're locking a housing payment in for 30 years. And what is your interest rate when you're renting? It's 100%. So think about that if you're worried about rates, and talk to us about ways that you could mitigate high rates, buy it down, whatever strategies you want to talk about, we're here for you. Same thing with sellers. You want to sell, you want a good price. We can still do it. It's not nearly the end of the world here, folks. Not nearly as bad as some people want you to believe, but there is room for concern here. So let's keep it sane. Give us a call if you have any questions. And as always, if you like this content, please like, share, subscribe, and comment. Tell your friends. We'll be back next week with more episodes of Neighborhood Real Estate Update and San Diego Market Watch next Thursday. So until then, have a good weekend, and we'll talk to you soon.